everyone, good evening. You're watching The Money Show on ET Now, the only show of its kind where we address all your personal finance queries. I'm Mubina Kapasi, and today we're going to be touching base with your tax-related queries, especially if you've missed filing your income tax returns. Do remember that for individuals, the last date is 31st of July. If you've not filed your return for the fiscal year 2018 by 31st July 2018, well, don't worry, you can still file them, but of course you will have to pay a fine. Not just that, we'll also be looking into the new income tax forms that the Income Tax Department has floated. I'm still talking about the earlier fiscals, of course, for fiscal 19. It's only in the next couple of months that the department will be floating new forms. But the one that has already been released makes one disclose additional information, particularly on their assets. So what are the key changes and how can one optimize their tax benefits? Let's discuss all of this with Mayur Shah of Ernst & Young India. And of course, don't forget that you can also call us on 6754-9474. Our phone lines are open now for all your questions and queries as well. Well, for now, let me introduce Mr. Shah back on the show. Thanks so much for joining in. Good evening. I want to first start up by talking about income tax filing, an important procedure, especially for those people who want to claim refunds. You're not going to get your tax refund if you don't file your income tax return. If that's not enough of a temptation to file your returns, I don't know what is. But Mr. Shah, in case if some people have missed on the deadline for the 31st July date, or 30th September date as well for some professionals as the case stands, what are the procedures that they must follow and what's available to them?
Thank you very much. As you rightly said that due date for filing return is 31st July or 30th September as the case may be. But if somebody has missed filing the return by then they can file it by 31st December by paying filing fees of 5,000 rupees. And if they are missing that deadline as well, then they can file by 31st March 20 by paying additional fee of 10,000 instead of 5,000. And this is the last date when you can file your return of income. Otherwise, you have to request for another procedure needs to be followed for filing the return then.
Fair enough. And what sort of penalty or fees would you have to pay for every day of delay?
So there is not a daily delay fees. What you have to pay is, if you are filing by 31st December after the deadline, then you have to pay a flat fee of 5,000 rupees. Or if you are filing by 31st March, then 10,000 flat fee which you have to pay. Now the persons whose income is less than 5 lakh and they have missed the deadline, then they have to pay penalty up to 1,000 rupees only in all the scenarios. So there are no daily fees, but if somebody has not paid taxes, then they have to pay interest at the rate of 1% for non-payment of taxes, and there are also implications for non-payment of advance tax, which can be 1% per month from the end of the tax year, and during the year if advance tax has not been paid, then 1% per month interest needs to be paid even for non-payment of advance tax during the year as well. So these are the repercussions, but there are no daily penalty which they are being levied.
All right. Okay, well, let's get to answering questions and queries then. Remember, this is all about taxation. So, and of course, you can see our phone number as well flashing on top of your screen. And the very first question is coming in from Nitesh. He is from Bengaluru. Hi, Nitesh. Good evening. What's your query?
Yeah, I wanted to ask you, in the latest budget, they have raised the limit for deducting TDS in the banks for rupees 40,000.
You're talking about interest.
Interest part. If it goes above 40,000, TDS will be deducted.
Okay.
So is that applies to private firms also where we have given deposits?
Okay. All right. Mr. Shah, would that raising of the limit be applicable even to companies, or is it only for individuals?
It is for all. It is for companies as well as for the banks.
Okay, Nitesh, I hope that answers your question. Regardless of the type of assessee you are, the ceiling on which the bank will deduct TDS on the interest income is raised as per the latest budget. All right. Well, next up, we have another question coming in from Harinder Pal Singh Dhillon. He asks, is a tax rebate under Section 87A applicable to an HUF as well? HUF is a Hindu undivided family. Mr. Shah, if you could just briefly touch upon the provisions of Section 87A as well as answer Harinder's question.
Sure. So, tax rebate is available for the persons who are drawing income to 5 lakh, which has been enhanced to 8 lakh now. The rebate is something which is available only to individuals, and that to individuals who are ordinarily resident of India, and it does not apply to any other other individuals. So, rebate will not be available to HUF, and it is only only individuals are eligible for the rebate.
Harinder, I hope that answers your question. Next up, we have Yojana, who has sent in a query. Yojana says, I'm unable to revise my belated returns for the year 2015-2016. That's 3 fiscal years ago. What should I do? Please help. Mr. Shah, what would you advise Yojana to do?
So, I am assuming that return, while it has not been filed within the timeline, and within the timeline where you can file belated return, what one has to do is file a letter along with the return and return of income with all other evidence, requesting them for condonation of the delay. While there is no procedure for condonation of delay, but one can write even to Central Board of Direct Taxes to condone the delay and accept the return. What it may happen is that they may issue notice for escapement of income, by virtue of it they will do an assessment and they will accept your return the way it is. However, any refund which is due on that, I am not sure you will get that refund unless CBT consider it to grant the refund.
All right. Okay. So, it's a bit of a longish procedure given the fact that it's a return that actually belongs to the year FY 15-16. So, just ensure you follow all the proper procedures. Well, again, a reminder for all our viewers, our phone lines are live. You can call in. The numbers flashing on your screens. Mr. Mayur Shah, partner from Ernst & Young, will be here to answer all your income tax. Okay. Just as we were about to slip into a break, we've just got a new caller from New Delhi, sir. If you could introduce yourself as well. Okay, it's Puneet, yeah. If you could just introduce yourself and what is the question you have?
Quickly, I'm Puneet from New Delhi.
Okay.
My question is that every year, the Income Tax Department adds back income on 14A against our assessments. We have to go in appeals, and then every time we win that appeal, what is the way to get rid of all that? Because it's wrong. Under 14A, we make investments for the same business, and that is added back each time. And then we are taken care of in the appeals. So that is my query, how to take care of that.
Okay, Mr. Shah, straight over to you. What would you recommend he do?
Yeah, so this is a perpetual issue, not just in Delhi, but I think in all the situations. What I understand is that you have income which is exempt from taxations, and you have a business or a profession in certain cases where expenses are incurred for income which are taxable. So far as you are able to demonstrate the expenses which are directly related to the income which is subject to tax, tax officer will not disallow. What one can do is that if department has not gone in appeal against the order which has been passed by the CIT appeal or the tribunal, in such cases the tax officer is bound to follow the order in subsequent year as well. Probably you may have to make a request to the commissioner to intervene and request him that I should not go through this harassment which is happening with me.
Mr. Shah, I would just like to know, do you think an advance ruling perhaps in such situations would help, given the fact that year after year, like Puneet said, he keeps going into the same process of assessments, etc. Do you think perhaps an advance ruling would be a way to at least ease the entire system?
The challenge which will be there, this advance ruling is, one can apply for advance ruling only in situation either they are dealing with non-resident or the taxpayer himself is a non-resident. I am assuming over here that such scenarios are not involved in Puneet's case, and hence advance ruling may not be applicable. But you are right, if Puneet is a non-resident or the income which is arising is kind of a sources outside India, then one can really try and go through advance ruling.
Okay, so advanced ruling is applicable only for NRIs. Fair point. I hope, Puneet, we've been able to answer your question. Next up, we have retired Colonel Bhargava, who is joining us on the phone line from New Delhi. Sir, what's your question?
No, good morning. I mean, my question is that I take positions in options to hedge my portfolio.
Okay.
And I normally hold my positions for about 2 to 3 months in order to hedge my portfolio. Now, the gains out of these portfolio, I am showing as short-term capital gain.
True.
Because I read an article in Outlook Money which says you can do it either way. When I'm doing as a short-term capital gain, I'm not deducting any of the expenditure which I incur on my trading. So is that all right in tax?
Okay, all right.
So far as if you are...
Go ahead, Mr. Shah.
Yeah, I'm sorry. So far as when you are taking a position in respect of options that it is a capital investment, it is fine. But one has to demonstrate that these are all your capital investment and it is not in the sense of business which you are carrying on. The moment you are carrying on as a business, it cannot be classified as capital gains, and you have to offer it as business income.
Okay, so classification of income and of course providing proof as well, whether F&O trading is actually reported as a business income or it's in the nature of capital gains. Okay, we'll do one thing. We'll just take a quick breather right here on the show. Just like retired Colonel Bhargava, you too can call in on the phone, join us live on the Money Show and ask your question to Mr. Shah. Until then, we'll take a very short break. Come right back. All right, welcome back. You're watching The Money Show, where we are answering all your questions and queries. Do remember, just before the break, we had retired Colonel Bhargava from New Delhi, who had joined us on the phone line. Okay, we do not have him now, but we'll try and reconnect with him again for a follow-up question he had on his question with respect to the gains he enjoyed on F&O trading. All right, well, let's do one thing. Let's address the other topic that we said we are going to discuss, and that is with respect to the new forms that have been notified by the Income Tax Department on the 1st of April 2019. Now, it looks like the scope of filing has been simplified, in these new ITRs, especially by small taxpayers. It's been narrowed down quite a bit. Mr. Shah, let's understand your own assessment of the new forms that have been issued, right from ITR 1 to ITR 4. What are your key observations on what has changed in the new forms that have been issued?
Sure. At the outset, let me say that, as far as all the ITR forms which are being notified, there are a couple of changes which are being made in the forms, which kind of tries to automate the entire system which is there. So, up till now, the requirement of the form was kind of giving a taxable value of an item without giving much of a breakup therein. So, now what they are trying to do, they are asking lots of information in the return form itself, whereby if I try and link it with their project Insight, where they were trying to do a data analytics of the data which they have collected from various sources from various other countries, and they are trying to match with the data which has been supplied with in the return of income. By virtue of that, they are trying to see that they will take cases for audit only which are critical and where information do not really match. So, that is one thing which seems to be the criteria on putting this form together. Second thing, what they are trying to launch is without any personal connection with a taxpayer, they want to complete the assessment, and therefore the information request, the data collections will happen through return of income, whereby they don't have to ask about much information in relation to that, except the evidence of the entire transactions which are being there. So, this is another way of trying to see that how they can assess without even connecting with the taxpayer. With that, as you rightly said, the forms are becoming much more simpler. It is becoming simpler, but it is asking lots of information. So, while filing the return, one has to be very careful, have full data on hand so as to file the return of income. Now, there are 4 forms for individuals which needs to be filed: ITR 1, 2, 3, 4. ITR 1 deals with individuals only, where a person who is ordinarily resident can file the return, provided his income is below 50 lakh and his income does not involve any income from agricultural sources or from capital gains. The only another aspect which is more critical for that is that a person should not be a director in any company, or he should not be holding any shares of an unlisted company. So, these are also other caveats which are there. So, therefore, this form is not applicable for non-resident or not ordinarily resident. For them, ITR 2, ITR 3 and are possible, and ITR 4 is also only for ordinarily resident, and especially those who are having business income which are being taxed on a presumptive basis. For rest of the people, for the rest of the individual, the form ITR 2 and 3 will be more relevant. Now, the changes which are there, and broadly speaking, the changes is requesting for many information. Now, if a person is a non-resident or
Mr. Shah,
not
you know
ordinary
what,
resident,
we're actually running a bit short of time, so unfortunately, I have to cut you out right there because we're getting a lot of questions and queries for you on the phone line itself. So, I think let me just first, for the benefit of our viewers, get to answering those. First up, we have Shrikant from Pune, who has joined in on the phone line. Shrikant, what's your Shrikant? Okay, no, before that, like I was saying, we had retired Colonel Bhargava from New Delhi, who was with us on the phone line. He's an F&O trader, or at least he does so. 2-3 month time horizon is what he has when he deals in his options. He wants to know what's to be done with the gains. Colonel Bhargava, you had another question for Mr. Shah?
Yeah, that's correct. Mr. Shah, you mentioned that if I am able to show as a capital investment, then I can treat it as a short-term capital gain. But are there any parameters? Because I find that these are gray areas where how do you take what is trading and what is the investment? I mean, can you clarify that, please, for me?
Absolutely. Mr. Shah, go ahead.
Certainly, certainly. Yeah. So, the criteria which are being used, and these are broad criteria, one has to go into nitty-gritty. The criteria which decides whether it is a business income or a capital gain. If a person is carrying out multiple transactions, and there is no limit in terms of multiple transactions, but if there are many more transactions which are being undertaken, then such income more likely than not will get classified as business income. If this capital investment is made out of borrowed funds, then again this will get classified as business income, because generally capital investment is never being made from borrowed fund. But again, as I said, it is a quite subjective test to apply whether it is a business income or not. Another thing is that in past years, how many such transactions has been carried out. If you are carrying out this transaction on and often and every year, it appears that you are carrying on a business rather than making an investment. So, these are the 3-4 criteria one evaluates to examine whether it is a business income or is it a capital gain.
All right. Colonel Bhargava, I hope that's been able to answer your question. I think we should move on to our next caller. It's Shrikant from Pune, who is joining in on the phone line. Hi Shrikant, good evening. What's your question?
Shah sir, namaskar. This is Shrikant from Pune. My query is very simple. I have account, NRO account with the bank, and I want to transfer this small amount, or say around 1 lakh rupees, to my NRE account. Bank is insisting for giving form 15 CA and CB. What do I do?
Okay, Mr. Shah, what would you recommend?
Yeah, namaskar. The point which you are asking is not from a tax perspective, but it is from an exchange control regulation perspective. Any money which is being transferred from NRO account to NRE account is considered as remittance from India to abroad. The reason why the bank is asking for 15 CA or CB is that whatever amount you are transferring is which is out of income, which is already been taxed in India, and therefore such remittance can be made. And this is the requirement under exchange control regulations which has to be fulfilled. Even bank cannot waive off this requirement.
Okay, all right, fair enough. Shrikant, I hope that's been able to answer your question. Unfortunately, we are completely out of time, so we're not going to be able to take any further questions. Mr. Shah, thanks so much for joining in. And of course, ladies and gentlemen, do remember this is a show where we answer your personal finance queries. Stay tuned. Tomorrow, same time, we'll be back with a brand new edition. And of course, stay tuned to ET Now for more news and updates.